All right, let's talk about corporate finance. Every big business decision, whether it's a huge merger or just launching a new product, it all boils down to a few core financial principles. So, in the next few minutes, we're going to break them all down and give you the same framework that really powers Wall Street. You hear that word all the time, right? Value. It gets thrown around constantly, but what does it actually mean? Honestly, getting this right is the key to pretty much everything, whether you're just buying a single share of a stock or you're thinking about buying an entire company. So let's start right there. So the first, most fundamental question you got to ask is, what is this company actually worth? And you know what? The answer, well, it kind of depends on who's asking. Are you an investor who's just buying a small piece of the pie? Or are you a buyer looking to own the whole thing? See, those two perspectives give us two totally different numbers. On one hand, you've got equity value. You probably know it as market cap. That's the price tag for the shareholders. But then there's enterprise value, and that's the total cost to buy the entire business, lock, stock, and barrel, and that includes taking on all its debt. Yeah, just think of enterprise value as the real all-in takeover price, because you're not just buying the fun stuff, the shares. You're also inheriting all the company's debts and other obligations. So how do you actually calculate that number? Okay, so here's how you build that bridge from one value to the other. You start with the equity value. Then you add what's called net debt. That's just all the company's debt minus any cash it has on hand. Because, hey, a buyer could use that cash to immediately pay down some of the debt, right? Then you just add in any other claims like preferred stock to get the full, complete picture. But wait, it gets a little more nuanced. The pros, they fine-tune this number even more by treating certain things like cash or like debt. For instance, long-term investments could be sold off for cash, so those get subtracted. On the other side, an unfunded pension plan is a future bill you're going to have to pay, so that gets added on. It's all about finding the true economic cost of the takeover.
Okay, so how do analysts even come up with these values in the first place? Well, there are really two main philosophies. You've got intrinsic valuation, like a DCF model, which tries to figure out a company's worth from the inside out based on the cash it's going to generate in the future. Then you've got relative valuation, which looks outside, comparing the company to others like it. Both are super useful, but both have their own pros and cons.
So we have a sense of what a company is worth. The next logical question is, how did it build that value in the first place? I mean, where did all the money come from? And that brings us to what's called the capital structure. Right, so every company faces this fundamental choice. They can fund themselves by selling off pieces of ownership. That's equity. It's flexible because there are no required payments, but it waters down the ownership for everyone else. Or they can borrow money. That's debt. It's usually cheaper, especially with tax breaks, but it adds a whole lot of risk because you absolutely have to make those payments. Okay, let's zoom in a bit. We're going to go from those big picture funding decisions right down to the nitty-gritty, day-to-day financial stuff that keeps the lights on and the products shipping out the door. And that brings us to something called net working capital. Basically, it's the cash a company has tied up just to run its daily operations. To buy inventory, make sales, and float the business until its customers actually pay up. Managing this little cash gap is a huge sign of how well a company is run. And we can actually measure how good a company is at this with a few key numbers. How many days does it take to get paid by your customers? How long does your inventory just sit on the shelf? And how long can you stretch out paying your own bills? Getting these numbers just right is absolutely critical. Now, separate from all those daily costs, you've got the big long-term investments. We're talking capital expenditures, or CapEx. This isn't money for this month's payroll. This is the money for next decade's new factory or a whole new technology platform. So while operating costs just maintain the business, CapEx is all about growing it. And right here, we run into a concept that's a little tricky but so important: the non-cash expense. See, when a company buys a big machine, accountants don't just expense it all at once. They spread that cost out over many years through something called depreciation. This makes the company's profit look lower on paper. But, and this is the key part, no actual cash leaves the bank after that first initial purchase. So we've got all this data floating around. How can we just quickly check the pulse of a company? Well, that's where financial ratios come into play. They act like the dashboard in your car, giving you a quick, at-a-glance check on a company's financial health. First up, let's check the leverage. How much debt is this company really carrying? A great ratio for this is debt to EBITDA. It basically tells you how many years of earnings it would take to pay back every penny of debt. It's a really direct way to measure financial risk. Now, having debt is one thing, but being able to actually pay for it is a whole different ballgame. That's where coverage ratios come in. For example, the interest coverage ratio tells you how many times over a company's earnings can cover its interest payments. If that number gets too low, you are definitely in the danger zone. And this brings us to the end of the whole cycle. After a company has been valued, funded its operations, invested in the future, and paid all its bills, what on earth does it do with the cash that's left over? Well, the company really has 5 main choices, and this creates a real tension. Do you reinvest that cash for future growth, maybe by beefing up operations or buying another company? Or do you return that money to your investors right now through dividends, buying back stock, or paying down debt? This single decision tells you a ton about a company's real priorities. So after all the formulas, all the ratios, and all the spreadsheets, we're left with one last question. We've seen the valuation is built on a ton of assumptions, and all these capital decisions are really just strategic bets on an unknown future. So when you get right down to it, is finance more of an art or a science? Now that is the billion-dollar question.